Hey everyone, man, this market just humbled people again. But something about this move doesn't fully adds up, and I didn't catch it at first. I'll show you what I mean in a second. Because if you go back just a couple of weeks, everything feels easy, almost too easy. You probably felt it too, right? Like the outcomes was already decided. People calling for Bitcoins to hit $100,000, like it wasn't even a question anymore, just timing. And that's usually where things starts to go wrong. Not when people are scared, when they are comfortable. And yeah, right on cue, Bitcoin drops under $77,000. But here's the thing, it's not even the drop that stands out, it's the reaction, the switch. That's where people get caught. 1 minute it's confident, next minute it's uncertainty. Same people, same accounts, completely different tones overnight. That tells you positioning was off. And when positioning gets too one-sided, it doesn't take much to flip things over. Now, was this random? No. There's always something underneath these moves. This time, it wasn't one thing. It stacked it. First, ETF flows flipped it. Not slow. Flipped it. Over $600 million flowing out of Bitcoin ETFs in just a few days. Now, most people hear that and move on. But think about what that actually means. That was consistent buying pressure. Real money's coming into Bitcoin every single day. Just gone. And markets get used to that kind of support. They lean on it. So when it disappears, even temporarily, you feel that imbalance almost immediately. And here's something else most people don't think about. Those inflows weren't just retail investors. That's institutional money, allocations, long-term capital step in. So when that reverses, even briefly, it exchanges the tone underneath the market. But that's not even the part that made me pause. This is where it starts getting interesting. And most people skip right past this. Yeah, when the 10 years Treasury yield started pushing up near 4.7%, that changes the environment, not the narrative, the environment. Because now capital has an alternative, a real one. And this is where people get this wrong. Money doesn't chase stories. It's weight risk versus return. So if you can get close to a 4.7% return in government bonds, it's way less risky. You don't need to take as much risk in something like Bitcoin. When enough capital start thinking that ways at the same time, you get pressure. Not loud at first, but persistent. And Bitcoin, whether people like it or not, feels that now. It didn't use it to. Years ago, Bitcoin kind of moves in its own lane. Now, it's part of the system. Liquidity in, liquidity out. It all feeds through. And higher yield don't just compete with Bitcoin. They tighten everything. Borrowing get more expensive. Risk appetite pulls back. And that creates a kind of slow pressure that suddenly showed up all at once in price. And right behind that, you got oil pushing about $110 per barrel. Now, this part sneak up on people because oil doesn't just affect gas prices, it feeds into inflation expectation. And we're already seeing how sensitive markets are to inflation. So when oil spikes like that, even if nothing official changes, the perception shifts. And perceptions is enough because now people start asking, are we really done with inflation or is this coming back? And if that question even starts floating around, the whole rate cuts narrative starts to feel shaky. And that narrative has been a big part of the bullish case. Liquidity is coming back, interest rates going down, risk assets like Bitcoin's benefiting. But if it gets delayed or worse, removed, then positioning has to adjust. And that's where things get fast because leverage doesn't sit around waiting to be right. It exits. One trader gets liquidated, price drops, that trigger another liquidation and then another. And suddenly, you're not in a normal market anymore. You're in a cascade. And that's why these moves feel so aggressive. It's not just selling, it's forced selling. Positioning get wiped out. And once that starts, it feeds on itself. That's the total amount of leverage positions in the market. When you get these kinds of sharp drops, a lot of that leverage get flushed out. And while that hurts in the moment, it actually resets the markets. It clears out the over-leveraged trader, the ones who will only write as long as price keeps going up. And once those are gone, the structures underneath can actually get healthier. But it doesn't feel like that while it's happening. It feels chaotic. And that's usually where people make their worst decisions. And there's one more layer here. And this is where everything's kind of tied together. Liquidity. Not just crypto, global liquidity. Because at the end of the day, Bitcoin moves when liquidities expand, and it's struggle when liquidity tightens. And right now, we're in this in-between zone. It's not full tightening like before, but it's definitely not easing the ways people expected either. And that creates confusion because the markets were starting to price in a smoother path, rate cuts, easier conditions, more money flowing into Bitcoins and risk assets. But instead, you're getting mixed signals, yield rising, oil climbing, inflation's not fully going away, and that's keep things tighter than people are comfortable with. And Bitcoin feels that tensions, even if people don't say it out loud, because it challenges the easy narrative. The simple one is Bitcoin just go up over time. But the reality is it moves with liquidity cycle. And when liquidity isn't clearly expanding, you got this. Choppy price action, fake breakouts, sharp pullbacks, moves that don't follow through. And that's a frustrating environment because it forces patience. It forces you to sit there without clear confirmation, and most people don't like that. They want direction. Ups or down, just tell me. Bitcoin doesn't work like that. It spends more time confusing people than rewarding them. And moments like this, where sentiment flips fast, where confidence cracks, where price doesn't behave cleanly, these are the moments that matter because they reveal positioning. They show you who was overexposed, who was just follows the crowd, and who actually has conviction. Now, here's what things doesn't quite line up. And this is the part I was talking about earlier. While all of this is happening, while sentiment flips, while peoples are getting shakeout, the bigger player, they're not reacting the same way. And that's unusual. Michael Saylor is still buying Bitcoin. BlackRock is still evolving through the ETF products. And long-term holders, they're not rushing to sell. They're just steady. And that creates a split. On one side, panic, noise, emotion. On the other side, patience, positioning, no urgency to exit. And those two don't stay separated for long. One of them is wrong. Either this is an overreaction and the market stabilizes once the excess leverage is cleared out, or this is the early stage of something deeper. And most people just haven't caught up yet. That's the tensions, not the price itself, but what the price is telling you underneath. So the real question is, where do you land on that? Are you looking at this like just another shakeout, something we've seen before? Or does this feel different to you? Because how you answer that is going to shape what you do next. And in this market, that's everything. Let me know where you are at.